If you have a look at 2017 performance of the real estate space, it was the best performing sector index. Not only did it double for itself, but it also posted the best gains for FY17 as a whole, or rather calendar year 17 as a whole. But the start of this year has been a little shaky. With that, it's down about 20% for the year so far, and one of the worst sector performers. But recently in the month of June, we spoke to a lot of management right here on Bloomberg Quint, and here's a compilation of what they had to say. And there's an interesting report that I want to point out to. So the first one was from Godrej Properties, where Mr. Pirojsha Godrej was actually in our studio and said that he expects the profit to double in the next 5 years and sees ROE of over 20% in the coming 5 years as well. Second company that we spoke to was Sobha, and they too expect that FY19 will be much better than what FY18 was, and there is good growth in the contract manufacturing business. The order book currently stands at about 2,500 odd crores that he was telling me. The third company that we spoke to was Prestige Estates, and they believe that they can clock 4,000 crores worth of new sales in FY19, and sustainable margins could be northwards of 25% going forward. So a very positive commentary from Prestige as well. DLF, the fourth player that we spoke to, once again they believe that FY19 will be much better than 18, and what they're actually focusing is on clearing the existing inventory that they have. So once again, positive from DLF as well. Now going on, if you look at the top 7 cities, what's turning the tide, this is as per an ANAROCK report for the month of April. They have come out with the report saying that the demand for April was up 25% on a year-on-year basis, whereas the supply was up only about 6%. The other one was what they actually believe that the mall space will actually see more traction, because they expect 85 malls to be added in the next 5 years as well. That's something to look forward to. However, Citi report that came out last week, that says that the recovery could still be a little more time away, because the demand is showing no signs of recovery, as well as the higher interest rates are delaying the margin expansion that everyone is waiting for. Just to throw some numbers, the demand for the residential space in Q4 FY18 was down 12%, whereas FY18 was down about 23%. For the new launches, once again 12% and 49% decline, as far as the quarterly and the full year numbers are concerned. Now, as far as the commercial properties are concerned, they say that while demand exists for the A-grade properties, the B-grade properties in the commercial space, those are actually seeing some bit of sluggishness for themselves. Once again, some numbers for you. The demand, according to the Citi report in Q4, went down 20%, while in FY18 went down 6%. And for the year itself, it was down. The new launches were down about 46%. So two contradictory views. On one side, we had a lot of managements and consultancies which said that FY19 could be much better, and the first one data also points to that. However, Citi on the other hand believes that Q4 FY18 and full of FY18 was sluggish, and the recovery is some time away.